The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. It is only intended to provide education about the financial industry. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this program is no guarantee of future results. Any indices referenced for comparison are unmanaged and cannot be invested into directly. Any references to performance of securities are thought to be materially accurate and actual performance may differ. As always, please remember investing involves risk and possible loss of principal capital. Please seek advice from a licensed professional.
And we are back with another edition of the Daily Dots. And I'm joined, as always, by the brain trust himself, Mr. Chase Taylor. More of the same. Not a lot going on. But before we get a rundown on the indexes, Trump's kind of ramping up the anti-Powell rhetoric.
That is for sure.
If he dumps Powell, if that somehow goes through, the long end's going nuts.
Yeah, I would agree. And for folks, if folks aren't following, he hammered him on Truth Social today. And that was kind of, I mean, whatever. That's like the fifth time that's happened. But then the Wall Street Journal story broke that he's actually been having very, very serious conversations for months about, no kidding, firing him. And apparently talked to Kevin Warsh like 2 months ago about, I want to fire Powell and give you the job. And even Warsh was like, like maybe you shouldn't. And obviously, I think at this point, Scott Bessent has been throughout being like, please don't do that. Please don't do that. That's a bad idea. And then, like 10 minutes after the little spat, the little comment today in the Oval Office, it was leaked that Bessent was strongly pushing back. So he's even making sure to get his leaks out pretty cleanly and quickly now to make it clear, not okay with that.
Yeah,
I agree. Yeah, the back end will. Especially if it's a lackey that gets the job in place, like then that's when the back end has to.
But legally, he can't.
So I think that's clear that legally he can't, but it's never been tried, and it would go to the Supreme Court. And I mean, who knows what the Supreme Court would say? But you can't fire him unless it's with cause, which has pretty. The legal framework for with cause is actually pretty stringent, and it's not because you don't like the guy's policy,
right? He has to have done something wrong,
right?
Yeah.
And there's only a year to go. Like you guys got to get to next May. So to me, why not just wait it out? But
well, I mean, I think that Trump probably sees this as a form of negotiation and is trying to get him to come in line and cut. I would just sit there and go, look, if you're going to get any movement out of the guy, first of all, like you and I were saying, I would sit there and be in Trump's ear right now saying, hey, now's not the time to cut. Hold on. The sequencing's wrong. If you want the long end down, give us time. Just hold on, because like you said, I think if you cut right now, I think you get the inverse of what you want. I could be wrong. I just that makes way too much sense.
We could be wrong for sure, but I'm totally on board. That's the way I view it.
Yeah, look, it may not be, and I think this is something people need to understand. It may not be based in reality. It may not have any duration to it. But if you look at the way the market is treating bonds and the way bonds are moving based off what is being said, like look at the way bonds react to news flow right now and tell me you don't think a rate cut's going to make the long end go berserk. It's just the way the market's working. Right now, maybe rate cuts are the right move 8 to 12 months out. I'm just saying right now, if you do it, right, like meaning maybe Trump's right. Maybe right now is the time. But if you want it on the lower end, right, if you want to lower the back end of the curve, you do it right now. Just look at the way the market's reacting. If you think the market's going to buy duration because he cuts, we're not watching the same market.
Absolutely. And give Bessent and the Treasury the opportunity to go, do what, he spoke out against, and that's to manipulate the curve. Like go do some buybacks and bring down the maturity even more. Maybe hit us with bills even that much harder.
Well, and then you've got a scenario. You look at and I don't want to jump out in front of it.
No, you're good.
But you look at the numbers coming out of the Philly Fed today. Okay, you throw a 30-year at 5.5 on that. with what's going on economically, you're going to see the S&P sell off another 20%. You could have the long end up 5.5 to 6. You know what I mean?
Right.
Like double whammy time.
Yeah, and I think a lot of people agree with the fact that, like, obviously you're going to get some inflation because prices go up, because I mean that's what inflation is. But I think it's clear that probably there is a nasty deflationary shock on the back end of that, as long as tariffs stay in place. The problem is the market isn't necessarily viewing it that way. And if you're Powell, when you see, what's going on with some of the inflation expectation data and with the bond market, like, you're like, look, that's probably right, but I'm not going to cut before the market goes there.
I think Powell sees what we're seeing. He might think, look, I think if you look at it straight economically without looking at the bond market, I actually agree with Trump. I mean, I think that you can justify, I think if you can justify cuts that we've had before, I think you have way more reasons to be able to justify them today. But if you're looking at the market and the goal is to get the long end of the curve down, I agree with Powell. I don't think now's the time, right? Like perversely, somebody needs to look at him and go, if you want the long end down, don't cut, right? You need to get that deflationary, recessionary fear coming in and get a bid under. And if you do it that way, I think the long end acts like it always does. And I think duration would be a buy there. But like you said, I just, maybe we're wrong. I would just challenge you, look at the way the market's reacting to news flow. Any hint of a lack of fiscal discipline, any hint of increase, right? The long end sells off.
It's like a bloodhound the last couple of months.
It is. And like I said, I don't think,
including today.
Yeah, I don't think it'll be long lasting. But again, you've got to assess if you're Trump. I don't think it looks good for you if you sell off another 20% on the S&P 500 and you got a 30-year sporting a 5.5 to 6% rate. I don't think that looks good.
No.
I don't think it helps you in your trade war. You know what I mean?
Right.
So I would just be like, hey, I don't understand. If he really is considering getting rid of Powell and he's really, I would urge him not to. I don't think that's a smart idea.
Yeah.
Not good.
Totally agree.
So before we get in the Philly Fed, give us a rundown on the indexes, would you?
Yeah, so S&P closed down 0.13. You had the NASDAQ essentially flat, down 0.03. Small caps up 0.8. Equal weight up 0.7.
S&P finished where?
Up 0.13.
Okay.
And you're up 1% at one point, around 0.6 just most of the day. So not a great close. And that's important because they were pounding the tape with how great negotiations are going. And they listed 6 different countries. Like, they were trying to let you know how optimistic everything is. And so there was a bit of a news failure today, which I found a little bit notable. Mag 7 was down 0.70. So, I mean, tech just really cannot get it together. Despite the fact that we were up 0.13, the rest of the world, it was up 1.03. So another, whatever that is, let's call it 80, 90 bips because I can't do math.
Wharton Community College.
It's junior college, not community.
My apologies.
Oil was up 2%, and this is mostly because the threats to keeping Iranian exports down have grown. I don't think it's because anyone's optimistic about the economy. Gold down 0.4, and that was with the dollar up 0.1. So the dollar backed its way up a tiny bit. 2-year was up 2 basis points. 10-year up 5, and 30-year up 7. So
I'll tell you what, that was one of the most bullish 0.4 pullbacks I've ever seen in gold. Like I was seeing it, pressed 3,000 beginning of the day, and I was like, this makes sense. Yesterday you and I were saying you're going to get time, and sure enough, miners and gold pulled back a little bit today. I got to tell you, the strength of it unnerves me a bit because it's gone up so much so fast. That being said, I'm very pressed to recall a time where I've seen gold act more bullish.
Yeah, I think what worries me the most is that I'm not worried. That's what worries me the most.
Yeah, I agree. Wait, let me throw a little caveat on there. At least in the foreseeable future, I see there being enough causes or enough impetus out there based on what's going on via trade and global economic, all that stuff, to where, gold can do whatever it wants to do and it can move, but it's hard for me to see, unless something significant changes in the global economic macro backdrop, it's hard for me not to see any real selling pressure on gold not to get picked up here.
Yeah.
There's too many uncertainties out there right now, and I think that provides really fertile ground for gold at present.
Imagine the pullback on a dollar spike and a lot of good news, but a pullback, none of that's going to make anyone want to stop diversifying into gold. I don't think so.
I don't think so either.
That's why. But again, that's why it's hard.
Well, when you
I'm not worried.
and it makes a whole lot of sense. I mean, when you're looking at the world today and the perception of the world, and I think perception really matters when you're talking about currencies, right? It matters. And it's not just based off Trump. People will be like, oh yeah, because Trump and America. Look around the world. Like all of a sudden, and like you and I were talking about, all of a sudden having a significant portion of your reserves sitting in a monetary asset that has no counterparty risk whatsoever. I mean, how is that not appealing in this environment?
Absolutely.
Right. It's like it's like the question mark card in Uno, right? It's like whatever you want it to. No, the wild card, right? It's like whatever you want it to be, right? Without currency risk, it's inverse currency risk. I mean, I look around the world today, right?
It's a good settlement asset for trade.
Yeah, if you've got 80% of your cash, you're any given country, right? You got 80% of your reserves in other people's currencies right there. It is not hard to sell me on taking the other 20% and then dumping it straight into bullion.
And something else to think about, I think, is interest. I mean, global growth is about to go down a lot.
Yep.
Because of trade friction. That means so are interest rates. I mean, the ECB cut again today. You're going to have a lot of cuts globally, which means that like hurdle rate to buying gold is just that much thinner. Because normally, when rates are 6%, like it's kind of a bummer to hold gold because it doesn't yield anything. But if rates are 1%, everyone can look at it and be like, well, who cares? I'm just going to buy the gold.
You and I talked a lot about this coming out of COVID, right? And I still find it really fascinating, meaning there was a total sign shift, right? Like prior to COVID, no matter what seemed to happen, you never had the impetus to get off 0%. And just when you thought it was coming, something else would happen, right? It's like you had deflationary, boogeymen hiding behind every corner, right? Same was true of gold. Any rally you saw on gold over that period of time. And I think back to one that we drilled. Okay, first time the Fed cut rates or raise rates, I believe it was December of 15. Does that sound correct to you?
Yeah, I remember it being in a December 15. I was in a parking garage in Reno the moment it happened. I remember for some reason.
Yep. Well, I remember it very clear as well, and the reason why is at the time we had a trade constructed where, remember at that time the narrative across Wall Street for years was you can't buy gold because the Fed's going to raise rates at any moment, and when rates go up, gold goes down, right? Well, you sit there for those scoring at home. That is the most vapid, ridiculous statement I've ever heard in my life. The all-time inflation-adjusted high on gold happened to correspond with the highest interest rates in U.S. history, right? Why? Because people buy gold to defend themselves against inflation, and guess why rates go up? Because inflation, right? But that narrative kept a cap on gold for probably 3 years, and so the trade constructed we had at the time was if gold is positive 2 trading days, arbitrary number, but I felt like that was the right one. If gold's positive 2 trading days after the Fed raises for the first time, we're going all in. And we did. We took a slug of the miners. Next 3 months, gold went on a 25% run. Miners were up 110%, right? We drilled it, killed it. Even then, when you step back and look, guess what happened? Guess what we did with those miners after we doubled in 3 months? I think we sold them all. And the reason why is every time something happened, all you saw were reasons to sell gold, right? No matter what it was, like it just, anytime you rolled the dice would come up, sell gold, right? Kind of like COVID, how it flipped things around on the inflationary side. I see the exact opposite scenario now, where literally you roll out different scenarios and you're like, yeah, gold would be helpful there. Yeah, gold would be helpful there. You know what I mean?
Yeah.
The exact same dynamic. This is why I love markets. It's so fascinating. You get stuck in these places and you're like, no matter what, these are the cards that come up every single time. Something happens and the whole game just reverses, right? I kind of feel like that's where we're at with gold. How long will we stay there? I don't know, but you have levels of uncertainty in the global financial system for some good reasons, for some not so. Whatever the reasons are, there is uncertainty in the global financial system that hasn't really existed in the same way in the last 40 years.
100%.
And it is what it is, right? And then you look at debt loads, you've got constraints on balance sheets that you haven't had in the last 40 years. And all things point to higher gold.
Yeah. No two ways about it to me.
And yes, I'm talking my book. No apologies, right? Like just.
But at the same time, like you talked about, we've been zero on gold and gold miners for periods when
for a long
time.
Like
we're just bag holding them for a decade and then just jump in.
Right.
So.
Right. No, it's okay. Now walk us through Philly Fed.
Yeah. So
because I the headline numbers were a little shocking to me.
Yeah. So Philly Fed is a piece of soft data. Soft data has been getting bad. Hard data so far, not getting bad. A lot of people are still clinging on to this because 2023 soft data was bad. Hard data never got bad. So I think a lot of people just aren't going to buy this until it transmits into hard. But as far as soft data goes being bad, it was terrible. So we had a really bad Empire manufacturing from the New York area, obviously, earlier this week, but that one can be really noisy and chaotic. I kind of just ignore it. It was bad this week. I'm like, okay, noted. But yeah, Philly Fed is kind of one of the more accurate ones that it just seems to correlate like with ISM better than a lot of the other regions and stuff. And it was bad. The headline number was bad. But more importantly to me, if like just new orders, which was atrocious for Empire, that was worse than any time in 2023 when people did get a little concerned. Obviously, you had the COVID spike lower, but you're right there with kind of the nasty levels you were at in 08. So they're telling you the new orders are awful, and then they have another measure for like what employment will look like in 6 months, and that thing is negative that it is never negative.
Yeah.
So, and it was very positive 4 months ago. So the employment metric for 6 months from now has collapsed in the last 4 months. And you really see that a lot across all manufacturing PMIs. Like they all exploded higher on the election, and then they've all basically gone back the other direction and largely made new lows in a lot of the key metrics. So it tells you import costs going up, supply chain problems is leading to people freezing orders. I mean, the uncertainty is obviously going to lead to a lot of people just freezing orders and be like, we're not buying anything for now. And it kind of fits into this view that we might have a sudden stop in the economy where you go from front running tariffs to like a ghost town for things like freight. On that, like I just started following a few freight accounts today because I'm realized like, all right, it's time to go back in there and start watching trucking and rail and shipping and everything again, watching, the delta between the rates from China to the US versus like Vietnam for the US for shipping, like all this kind of stuff that was actually sort of important during COVID when the supply chains all locked up.
Right.
You're kind of right back to that being really important. And trucking is the leading employer in basically 2/3 of the states. So if you have a sudden stop that hits trucking because of way less shipping from imports, like that absolutely cascades into jobs.
The other thing I'm hearing, again, anecdotally, but I'm hearing multiple reports of people that are in China talking about how they're seeing increased signs of economic duress, not less.
I mean, they have to, yeah. When these trains and ships and trucks stop flowing here, like the same thing is going to be happening there. Their ports are going to be less busy. Some of these factories just make American trinkets. Like it's not, they don't get the throttle down. They just go cold.
Right.
So yeah, I mean, their economic activity will no question go down.
Yeah.
one other thing, data wise today, we did get housing starts and permits. Permits were okay, but starts were bad. This single family starts had one of the bigger month over month drops that we've had in the last 5-10 years. So
Construction jobs still hanging in there though.
so far, which is interesting at the least.
I don't think that that's going to be a gradual thing. I think you're going to get one shocking print, and I don't think you're going to get a warning.
Yeah. Or you get one kind of bad one, and then everyone goes like, oh, okay, everyone's going to do it, then I'm going to do it. And then that next one is just the full release.
I honestly can't figure out what's keeping them holding on this long.
I mean, it's clearly not a great time to buy a house for people.
Right.
It's not a great time to build a house if you're a builder.
Right.
So I would expect that, like a lot of other activity, to kind of seize up. And with that, jobs become, an obvious casualty.
Yep. Let's see. What else do we discussed it? Another one, some interesting comments out of Jensen Huang in video today talking about, and this is his words. He said that China's producing chips that are way closer to the capability of their the H2N100 or whatever it's called.
Yeah, I can never keep up with
HN200 or whatever. Their top flight chip. He said that China's producing chips that are way closer to that capability than was previously thought.
Well, he's in Beijing this week, so he would know.
Yeah. Reason I bring that up is that's kind of another one. It's already been hit a bit, but boy, the backdrop for NVIDIA sure looks different than it did 90 days ago. You know what I mean? Like pre-DeepSeek, if you look what's happened then, and I think DeepSeek was like 90 days ago, there's just a lot, you know what I mean? Like there's just it's a different story right now looking at NVIDIA.
The potential efficiencies for AI have improved a lot. The CapEx desires for the hyperscalers in the US have retreated. And then if you really think, if the economy is going to kind of lock up and go into recession sometime this year, it's not like Microsoft's going to be tripping over themselves to, break ground on a bunch of new data centers. So that can
not.
That can keep getting worse, right?
They're not.
Yeah.
And again, no inside information, but just getting additional color from contacts I've got inside the company. They have slammed the door on data centers for now. Like it has been surprising to me to hear how resolute and how fast and swift and decisive that move was.
Yeah.
Right. Now, I don't have the reasons why are purely anecdotal, but these people are in the know. They're claiming it has everything to do with increased efficiency in chips, and Microsoft's taking a step back and going, whoa, hold on. Before we spend all this money.
It's a lot of money.
Yeah. And also, they are feeling more and more confident, speaking to people, again, working on this stuff at Microsoft. They are feeling more and more confident that the DeepSeek type thing is the way forward on this, especially as it relates to. So the way that they were explaining it to me is that if you are still building an LLM from scratch, the initial phases of building that foundation, if you will, is where the NVIDIA chips are extraordinarily useful. But if you're piggybacking off of existing technology, you can get now I'm not smart enough to understand all this, but a guy that is working heavily involved in the AI team at Microsoft was explaining this to me. And he said, on a lot of these applications, if you can build off the back of an existing structure, that you can get as good of efficiencies doing it in similar ways to DeepSeek. And in some ways, he said better. Now, again, I don't pretend to understand it all, but
and it's cheaper.
Yeah.
You think about it,
way cheaper.
If you're just building an app on the backbone of it, like all you care about is it good enough for my end user to be happy, and is it affordable enough for me to make money?
Right.
I think it's easy to lose sight of the fact that the best technology, the coolest technology, isn't always what gets the most heavily commercialized, right?
Right.
What gets commercialized is what
the intersection of cost and function.
Yeah.
Yeah. Yep.
So it makes sense to me that the small, nimble, cheap, but effective models are going to dominate, and those need less chips.
Okay, now I'm going to say something. We don't have a position on here, would have obviously rather pulled this move at $1.50. You might recoil in horror when I say this. I'm starting to feel like Nvidia looks like a pretty attractive short at $100.
You say short?
Yeah.
I mean, they're going to be under 20 times forward earnings soon. That makes it, they're going to be cheap versus their own history. I would say this: if you think they're a good short, then it's tough to defend some of the other Mag 7 companies that are kind of in similar boats. They've similar drawdown, similar.
You're right.
You know,
Apple's still a better short.
Oh, to me,
Yeah.
not as of the way the world is today, not even close.
Yeah.
But
I got to watch that, because being a bit contrarian like I am, sometimes the intellectual attractiveness of a short can kind of trip me up, right?
Oh yeah, trust me, I know.
No, I would just Nvidia. It's not what Tesla was to me at one point, but I would just love to make some money short Nvidia, and that's where I got to remind myself. No, the name of the game is just to make some money.
Yeah,
right. The money doesn't care how it gets made, right? And you're right.
Carvana is always that one for me. It just makes me so mad that I want to make money short it, which it did. So,
oh man, yeah, I'd like to. You know what? Let me switch. I'd rather make money on short.
That one offends me. Yeah.
It does.
That's the kind we shouldn't even do usually, but the ones that are offensive.
Speaking of Carvana, we actually have a listener who's does it in his spare time, but very smart analyst and does some really good work. And he was DMing me on Twitter, and he passed along some really interesting information. You don't want to. Carvana's biggest moves try to generate revenue is they're buying wholesale cars out of Canada right now and reselling it because they're getting a discount in Canada. Anyway,
hey, at least that's creative. That's kind of thoughtful.
No, it is. But at the same time, I laugh so hard because these are the things you see in ridiculous bubbles. Guys, they're a used car company. Okay. And they're probably not kosher either.
Yeah, subprime lending. Used car company.
Watching the mental gymnastics trying to turn that into a tech darling, it's just hilarious to me. Right. Especially if you go out and look at what kind of multiple you can buy car dealerships for. It's just complete. Right. Well, and they're like, yeah, but it's an online car dealership. And you're like, so is every car dealership on the website. You know what I mean? It's just
maybe owning some land's a feature, not a bug.
yeah, maybe. And when I see things like that, that's kind of one of those things to me. Again, this could be different, but it's one of those reasons why I believe, more pain is in for US markets. This is not an environment where you would expect things like that to slide by. You know what I mean?
Right.
You would expect it to get pounded. And until I see air come out of those things and some serious air, it's hard for me to imagine US markets being attractive while those things still look anywhere like they look right now.
Yeah. And that's the thing is there's still giant gaps to close.
Yeah. And we're not even talking about, we've been pounding this drum for a while, but it seemingly gets even more ridiculous each day. You just go do the comparable analysis, right, of US based stocks versus a international counterpart. It's just insane.
Speaking of, I did a 3-year look back on the country ETFs versus the S&P. And I mean, the S&P at this point on a 3-year look back is up like 8% or something like that. And then number one is Argentina in returns. Number 2 is Greece, which is like 24% return over that 3 years. And it's still, despite the fact that it's the number 2 best in the world for the last 3 years, and it still trades single digit P. Like that, I feel like that encapsulates what we're talking about.
Yeah. Yeah. Well, yeah, there's just no money there. Right. I mean, at the end of the day, right. there's just no money there, but that money is increasing and you can see it. Like, a really good way to wrap your head around this market is it literally is just the inverse of the last 12 years, right? Every day you look at Europe and Asia, it's a mess. US is up 80 basis points to 100 basis points, right? It's just the exact inverse is happening.
Almost every day this week, I think. They've outperformed, which is intense.
Another thing I thought was funny. You and I were joking about this yesterday. We had one of our better days of outperformance yesterday. I think we were up 40, 45 basis points. S&P was down 2.25 or something like that. I came in fully expecting to give the lion's share of that back today. That didn't happen.
I know. Every time it doesn't happen, it's weird.
I know, it's really weird. Like if I get to take one step forward, I'm expecting to have to take 2 steps backward the next day.
And American exceptionalism wasn't great for our style. So
No,
having the
no.
Mag 7 not just go up 8.8 every day for no reason is very helpful for active managers. That's for sure.
It really is, man, and it's exciting. Like
and that's with us owning some of it. Like,
Yeah.
you know,
Yeah.
some of it got cheap enough. We're like, okay, we'll take a little bit.
Yeah. But yeah, I was trying to explain it to a client today, where I was explaining it to a client today, the spread in valuations. And, sometimes you look at something and it gets more believable and more palatable over time. And usually I feel like that's kind of the way things work. And then there's other times where the more you look at something, just the crazier it seems, I kind of feel like that's what's happening on the valuation spreads. Every piece of news that you go back and look around the world and you're like, wait a second. The 2 very similar companies, and you still think this is worth 4x the amount just because it's US listed. That just seems insane.
Yeah.
It just, that dog don't hunt, man.
Nope. One thing I wanted to mention before we go is buddy Powell Macro, he flagged a Redfin survey today that I wanted to mention. Is basically just asking people about, hey, like if the tariffs like impacted your plans to do big purchases, and if so, like, and just a survey along those lines. And what stood out was the people that were most likely to cancel major purchases were the oldest and the most wealthy. So the people with higher incomes and the people that were older, it just kept skewing higher for the odds that they were going to cancel purchases, which is obviously something we've talked about a ton. Like the people with money are older people usually, and obviously higher incomes, more money. So the fact that is the cohort most likely to back away right now is a little scary, because again, I've cited this before, but the top half of wealth and income, or the top 10%, sorry, are worth 50% of the spending. So if that top 10% kind of backs away, then it does way more damage than it seems like it should. Everyone else can chug along as they were.
Yeah.
If the top 10% takes 2 steps back, it's bad.
Yeah.
So, it's a survey. Who knows what these people actually do with their money, right? But worth noting that, and I think the number, 31% said, I'm canceling a major purchase this year.
Really?
Yeah. So almost a third, and that was 55 up, and then 29% of people that make 100K plus said, I'm going to cancel. So that obviously not good for the home real estate, and that's why obviously Redfin would be out asking people.
Wonder why?
No, their 401k.
That's it. A 10% slide on their 401k, and you think that's already impacting purchases? Really?
That, and for some, obviously less so in the 55 plus cohort, you would think, but some people worrying about their jobs. There's a bunch of different surveys where they try to capture, like, hey, how do you think about your job a year from now or whatever? And that stuff's really sliding.
Yeah. And you know what? I've actually heard it. Our clients are up on the year, and I'm still hearing them really worried, right? Like there's and it's one of the things that you got to keep an eye out for is the recession can get you, but the fear of a recession can make one too.
100%.
You know what I mean? And, that
stuff can feed on itself too.
Yeah.
And we've gotten babied. People are just used to their account going up 20% in a year. So
it's really bizarre culturally, the way investing is looked at. It makes me extraordinarily uncomfortable.
Yeah.
And the expectations people have, and boldly having those expectations with ironclad belief that what they're asking for is totally normal. Like if markets go down at all, what's wrong? And you're like, that's what they do, right? Like, do you panic when you see a dog taking a pee in your yard? No, that's what he does, right? Like, it's very strange to me.
08 was 17 years ago. Like, that's a lot of time for people to forget, the way this stuff works.
Well, like I was saying to somebody the other day, to put it in context, right? The older you get, the less serious or the less gravity, these numbers of years seem to hold, right? Like there was a point in my life where 15 years seemed like an eternity. You get to 43 and you're like, yeah, 15 years isn't that big a deal. Well, you step back out, right? 15 years is a quarter of your life after the age of 20. If you live till 80, that's a big chunk of time, right? Especially in this industry. And I was saying, and we've talked about this before, but I was saying to the guy that I was interviewing, I go, just think about the guy that started in the industry as a junior analyst right out of business school in 2009, right? He's made really good money. He thinks he's got a handle on this. He's now a vet. He was a junior analyst. Now he's a PM.
Yeah, now he's pushing 40. Yeah.
Now he's pushing 40. One style has worked for him every year, and it's been outstanding, right? It's like the old story Rick Rule tells. You ever tell you when Rick Rule got in the precious metals game in like the late 70s, right? I mean, you couldn't start at a better time. And by his late 20s, he was a millionaire already, and everything he touched had turned to gold, and he thought he was God's gift to investing. Then the metals bear market hit, and he went bankrupt, right? It happens, and everybody conflate, especially when it's your first run of your career. You're gonna conflate brains with a bull market. You've got no other prior experience to run it up against. You know,
it makes me think of the Stanley Druckenmiller's boss back in Pittsburgh. It was like,
find me a young guy.
I'm putting you in charge because you're dumb enough to like go like charge, and the rest of us have too many scars. We'll be too afraid to do it.
Yeah,
I need someone dumb enough to do it. Is basically what he told him.
Yeah, and I think that it sure looks like there's a lot of folks that are about ready to get scarred.
And now it's reversed.
Yeah.
Now everyone has been rewarded heavily for charging every day, and so no one's afraid. You
know, the odd part about it is, and again, we don't know, and I'm not saying we have a monopoly on the truth and that we're the ones that understand what's going on. But when you talk about the drivers of all this stuff, it's just really obvious, right? It's shocking to me how many people aren't catching on to that.
I was thinking about this on the drive to work today, how, I have no formal academic training in finance, economics, but if I hadn't done the work to learn about things like trade deficits and current account deficits and like just the way those basics work, like this would not have been easy to capture.
Yeah.
Like that understanding of the feedback loop, if you will, between like a trade deficit and then a capital surplus, and what that means for capital and performance. Like sometimes the basics are very powerful. And I think this moment in time, like obviously not enough people read history. That's holding people back right now. And not enough people look at the no kidding, just meat and potatoes of what's going on, of something as simple as the capital count and trade account.
Okay. Now for the seasoned investors out there, this is going to sound like one of those like common sense, like, of course, but people need to understand that there's an extraordinarily large swath of folks out there that don't understand this. And I think there's going to be some painful lessons learned, meaning a stock market or any market does not reflect value. It reflects the most recent purchase prices, right? So flows matter. And if you don't know what I'm talking about, go read about it. Okay. Because at the end of the day, too many investors think stock markets or markets of any kind reflect real value. They do not. Okay.
Right.
I don't care what is going on in the world. A market that is getting the flows will go up. A market that the flows are going out of will go down. Period. End of story. It doesn't matter what you think is going on in that economy. None of that matters, right? It's a game of flows. And if you understand what's been going on for the last 15 years, you and I have talked about this a million times, right? I don't know when it's going to happen, but the greatest inflow story of all time that has perpetuated the largest and longest running bull market of all time, those flows will reverse. And I don't know why. I'm not sure what's going to cause it, but when that happens, get out of the way.
Speaking of, I saw an awesome chart today from the Shrub. That it was I think it was Swedish. It was showing Swedish flows, where it looks like pension, sovereign wealth, whatever is not playing around. They're not going to be the last people to do it. They were repatriating in size all of a sudden. So That tap has reversed for
Well,
sure.
and look, and that's the other thing that you got to throw in there, right? Something like this gets everybody's attention, and they begin to start looking through their books. If you don't think they're seeing what we've been seeing, right? Look, the reason, if you look at the last 2 years, money was not in the United States because they thought valuations were compelling. Money was in the United States because you get fired if you weren't, right? That game has reversed. It's changed. And now it always happens after the fact, right? After the bubble pops, then they start going, well, wait a second. Look at the value spread. You know what I mean? Like
the first couple of sheep have already like bolted through
Yep.
the hole in the fence.
Yep.
And the other ones are looking around like, we should probably do that too.
Yeah, and I'll just tell you guys, you don't need to be Buffett. Like, it's really obvious, right? Like, we're not talking about deep diving and coming up as a. We're looking at companies that are in the same industry. One's doing better than the other. The company that's doing better is trading at 1/5 the valuation. It's that drastic. Not on everything, not 1/5, but I'd say on average, I see 3 to 5x valuations for comparable type companies and comparable results. And so, and like I said, it's just kind of human psychology. The more pressure you see, the more people, it sounds backwards, but the more the rest of the world outperforms and the more the US struggles, the more people will become aware of the valuation gaps.
Yeah, it's reflexive.
Yeah,
for sure.
It shouldn't be, but that's the way it works.
100%. And speaking of Buffett, I think it's kind of worth noting, like, we haven't heard any stories of Buffett out there buying anything hard yet. He's going to do it whenever it,
it ain't raining gold.
Nobody wants to buy anything.
Yeah, it ain't raining gold.
Yeah.
And you and I are waiting for the same thing.
Reminds me of Ronnie Coleman. Everyone wants to be a bodybuilder. No one wants to lift these weights.
Yeah.
I feel like this Buffett, like, everyone wants to be Buffett, but no one wants to sell when everything's going great, and no one wants to buy when it's terrifying.
So speaking of bodybuilding quotes, my favorite is this guy looked at Arnold and he's like, yeah, I don't want to get into weightlifting because I don't want to look like you. And Arnold goes, don't worry, you won't.
Yeah, so true. So
don't worry, you won't. Oh man. Anyway, anything else you got to add?
No, that's good.
All right, brother. Well, that does it for me as well.
Are we back Monday?
Yeah, we're back. Yeah, we're back Monday. Markets closed tomorrow. Yeah. No dots we need to do. We got Good Friday stuff going on tomorrow. So we'll be back Monday. And as always, don't forget, this is on video again. So if you want to see our beautiful, pretty smiling faces, go to YouTube, Know Your Risk Podcast. You'll find it underneath there. We're going to be on TikTok, on Instagram as well. Know Your Risk Podcast. But to subscribe to the podcast, knowyourriskradiopodcast.com. We're going to get it ironed out, but just right now, there's that little bit of spread because as we've told you, we're no longer on the radio. So anyway, hope you guys have a wonderful evening and a wonderful weekend. Happy Good Friday. Happy Easter. God bless you all. We'll see you next week. You're listening to Know Your Risk Radio or the Know Your Risk Podcast. Download and subscribe at knowyourriskradio.com.
Investment advice cannot be given without a client service agreement. Zach Abraham is an investment advisor representative of Trek Financial, an SEC registered investment advisor. Bulwark Capital Management is a marketing name only and does not carry a separate registration.